Good afternoon, everybody. Welcome to Trading the Close. My name Gareth Soloway, and I'm with Verified Investing. Not in studio still at a hotel, but I'll be heading back tomorrow around the midday time frame to see what is going on with my house back there in Clearwater, as well as seeing what other damage is. But pretty nasty storm, there's no doubt about it. But again, the family is safe, and we were able to avoid a majority of the craziness here. All right, so first and foremost, this morning we got some pretty wild data. The data came in hotter than expected on CPI, 1/10 over what was expected. It was expected to be 0.1% on CPI month over month, came in at 0.2%. Year over year was supposed to be 2.3%. It came in at 2.4%. Now, in general, that's not ridiculous. It's not like, holy cow. But at the same time, we've been riding this narrative that's been spun by the institutional money as well as kind of the media that everything is returning to 2% inflation. Like, don't worry, it's going back to 2%, so the Fed can cut as much as they want. Well, now there's a little crack in the ice here or in the glass. In addition, jobless claims this morning coming in at 258,000 people filing for unemployment. That was well higher than expected, which was 231,000. So now you have a scenario where you're like, it's like, okay, so the narrative was everything is fine, the economy is great, we're not going to have a recession, and inflation's going back to 2%. Yet both these points on data, CPI and jobless claims, are now making a little bit of a tricky scenario here. Now, Austin Goolsbee was on CNBC earlier today. He's the Fed president from the Chicago Federal Reserve. And he said, hey, listen, it's one data point. While I agree with that, I do say, and I will point out, that we need to see what's going on here. But the valuations on stocks make it very tricky to justify if we have a potential for an uptick in inflation and a weakening economy. Remember, when you have inflation going up but the economy weakening, that's called stagflation. Don't be shocked when we start hearing that term more and more amongst many of the great minds in the financial world. All right. Now, let's go into some charts here and take a look. The S&P 500 on the day, we are seeing it here, folks, basically rallying back off of the lows at the end of the day. Look at how kind of lackluster it was. We opened lower on the CPI data, then rallied up. We went green briefly. This is where we closed yesterday. And then we sold off back down to the lows. And then we're getting a little bit of a bounce here into the end of the day with about 2 minutes remaining in the stock market's session here today on this Thursday. All right. So again, a little bit of a down day, nothing to write home about. The markets are going with that narrative that it's a one-off number on each of those points on the economist side, and there's nothing to worry about. That's really what we're seeing in the markets today. Now, if we go to the daily chart, I do want to show you guys a pattern formation that tells me that near term there could be a little bit of trouble. Take the low from August 5th, connect it through the low here on September 10th, and bring it right up underneath the recent lows. Look, exact low to this low here, pierced here, touches exactly right here. This is a key trend line to watch. In addition, take this high, stretch it right through these highs here. This is what we call a wedge pattern. Now, wedge patterns that are vertical like this, that are very sharp to the upside, you can see that the angle is very steep. These have about a 70% chance of breaking to the downside. All right. So again, it favors a breakdown versus a breakout. Now, I'm not going away from the idea that we still could see 6,000 on the S&P, maybe even 6,100 like I talked about yesterday. But at least in the near term, if we break this line, we would then go back and test this line here. Okay, so this is your line in the sand for bullish bearish. So as long as we stay, even if we break this line, all it means is we're going to come down here on the charts. It doesn't really mean that much other than that. Now, if we break and confirm below this line, that's where trouble starts. But again, if you have a little breakdown here, look at what can happen, right? So we could still technically see 6,000 because what would end up happening is you can do something like this. And I'm just extending my trend lines out just a bit. But we could see, okay, we break down here, we go here, and then you could even go up and go back to these lines, which would be resistance, and you'd even make a new all-time high. So again, as long as this line holds, this is the line in the sand. This one is an interesting short-term little wedge, which favors maybe a little bit of a dip. But as long as as long as this one holds at around 565 on the SPY, then you maintain a bullish, neutral to bullish bias. Okay. All right. So I just wanted to go over that with you guys because I think there is a little bit of a distinction there that's important to kind of recognize. And again, it will help us kind of monitor. But again, for those of you home gamers watching, all you care about is this line for the bullish bearish. But just in the short term, if we break here, then we probably at least test that line in the sand. All right, couple other charts to look at here, guys. JP Morgan Chase reports earnings tomorrow morning. One of the things I wanted to just point out on the JP Morgan Chase chart is number one, you have a channel. We are hammering on the channel. 1 hit, 2 hits, 3 hits, 4 hits, and 5 hits. All right, every time after 4 that we hit, the probabilities of breaking increase, which means if we sell off on JPM's earnings and we hit this, the odds are about a 75% chance that we break, maybe even 80% chance that we break to the downside. Now, one of the things that would be a bearish factor going in, I'm drawing a head and shoulders pattern here. Look at this head and shoulders. All right, to me, this looks pretty solid. There's your head and shoulders, right? So shoulder, head, shoulder. So again, this line, really, really important for JP Morgan. It's called the neckline, which is the connector of this point to this point and right in here. This, again, if we break this, you can actually do a measurement, a measured move, and figure out the downside target. You drop a plumb line from the highest point of the head to this trend line here, the neckline, and you take that distance, okay? And wherever it breaks, and we don't know where it's going to break yet, you map that out, and that gives you your downside target down here. So it would be about $180 target. Now, again, the reason why I'm looking at JP Morgan is because they report earnings tomorrow morning, and that's going to be very, very important to watch and see. I mean, maybe we don't break this line. Maybe we just test it. For all we know, we go up. All right, that's fine too. But if it does come down and hits this line, remember, 75 to 80% chance it breaks in the coming days. And then if it breaks, game on for the calculated target, measured move target on JP Morgan Chase. Another stock in motion, take a look at this trend line, guys. First, solar down almost 10% on the day, but look, more importantly, take a look at this trend line here. This is a major breakdown on this chart, major trend line closing below. Granted, it hasn't confirmed, but if it confirms, you're likely headed down, I would say, to 160, maybe even 140 on First Solar. So not a good price action day on First Solar, breaking a long-term trend line going back to the beginning of this year. One stock that I've highlighted to you guys, both in trading the close and the morning game plan, is Celsius, and look at it today, up 14%. Yesterday, I think it was up 6%. So we're talking 20% gain in 2 days since I talked about this major trend line zone right here, guys. And I'll bring you more of these kind of levels when I see really big disparities in charts. Look at the trend line here. Look at the trend line right here. Price right there, way oversold. Boom to the upside. I love those charts, man. Those are like some of my favorites. I'm still in the short camp on Carvana. It's kind of the opposite of this. Again, listen, it'll fall when it wants to fall. Right now, it's up about $1.50 on the day, but ridiculous extension move here. Almost the opposite. Like if you took the chart of Celsius and flipped it around, this would be the chart here of Carvana. And again, very way out of whack in terms of valuation metrics and technical metrics. All right, let's go to Bitcoin today. And I wish I had better news for those Bitcoiners out there, but Bitcoin continues to show relative weakness to the stock market. Remember, one of the things I've talked about, guys. So again, I've talked about this and I've gone over it every day this week. I said, guys, yes, Bitcoin's holding the pivot line, which is positive, but the weakness relative to the stock market is very concerning. Well, guess what? Today, guys, we broke below the pivot line. So listen, breaking below is okay, but if it confirms, game over, at least until 52,000 down here. So just watch this really closely. But we could see it earlier in the week, right? I mean, yesterday, look at the price action. Yesterday, the S&P was up 0.7%, and Bitcoin was down sharply. I mean, that is really weak performance for an asset that follows the stock market so well. It does open up, again, the probabilities that we head down to target support number 1, maybe even technical support number 2. Gold and silver had a good day today, folks. So again, nice day on gold and silver, getting a bounce back. For those of you that have taken the Winning Trader series, look at this, 1, 2, 3, 4, 5, 6. That's a time count. Tells you a bounce is likely. We're getting that bounce today. I talked about that yesterday as a possibility. If we flip over to silver, and by the way, gold is still going to go lower per the overall analysis, but a reprieve day is not shocking. Same thing on silver. If you look at silver, silver was at last Friday, so basically 1 week ago, it traded at $33, came down to $30, so a 10% drop, and now it's retraced to 31.15. Very standard. I still think it comes back in here. per technical analysis. All right, oil today, big bounce on oil. Again, after some nasty 2-day selling, low yesterday was down here, good bounce back here. Really, to be honest, I still favor the bigger picture of oil going down. But if it goes up here, I'm just going to use it as a shortable level. Major trend line right up here around $80 per barrel. And again, I think overall, I still have a 2025 downside target of $50 or below. So we'll watch and see if I'm right. I mean, it's getting to the end of the year. So 2025, at some point next year, I still think sub or 50 to sub $50. Now, I did take profits on my shorts on natural gas early this morning in the pre-market. This was a beautiful thing here, folks. Take a look at that. This is what I love showing, is that greed is not good always. If you're greedy, you're still looking for more downside here. Yet we took profits down here in the pre-market session, right down here, and just said, enough's enough. I think we banked 19% on the second half of KOLD after 15% yesterday. And then UNG with my commodities members, we took about 8.5% today on that early. And we would have given up a decent chunk of that. Not a huge amount, but certainly it got to bounce off those levels. And so you just have to you want to balance greed and target prices with risk and versus reward. And when you're down, at the time we were down 5 days in a row on natural gas, you have to say, okay, well, probabilities are starting to flip. Yeah, I might be able to squeeze a little bit more juice out of that lemon or that orange or whatever you want to say, but there's not that much to be squeezed here. It's oversold very short term. Let it bounce. I can always reshort it. That's the beautiful thing about it. Or if it doesn't give me another opportunity, there's always another trade. Always another trade for us to take. And that's the greatest thing about trading, folks, is there's always another trade out there. All right, so to summarize, markets flattish to negative on the day, kind of brushing aside the CPI data and the jobless claims. Tomorrow morning, Jamie Dimon will speak about the JP Morgan earnings. We'll get those earnings out. Wells Fargo, BlackRock reports. Earnings season begins. Thank goodness. I love earnings season because it creates volatility. And for a trader like myself, that is exactly what we want in the market. We want big moves. It gives us disparity in price, which then we can trade off of and get great swing trades. I can bring you even more potential trade setups here at verifiedinvesting.com. All right, guys, I will see you all later. This is the last trading to close. Remember, we don't have it on Friday, but I will be back tomorrow for game plan at 9 a.m. live and be going over all of the earnings from the banks as well as the price action. Have a good one. Take care.